Market access today isn't a one-way street anymore. From deep liquidity and credit intermediation to seamless retail platforms and copy trading, and landscape is transforming fast. This next panel brings together the experts shaping how FX metals and digital asset markets connect smarter, faster, and more flexible than ever before. Please join me in welcoming our moderator, Nick Twidale, the Chief Market Analyst at ATFX Australia, and our panel of market leaders.
Thank you very much. First up, I've just got to go for a quick disclaimer, which is a little bit boring, but we'll get that out of the way. So the speech herein is for professional knowledge sharing and networking purposes only, should not be regarded as or constitute a distribution or an offer. Solicitation to buy or sell any investments. ATFX does not promote or provide products or services, say for leveraged foreign exchange products in Hong Kong. You should always seek independent professional advice before making any investment decisions. Sorry about that one, but we've got it out of the way. So, guys, obviously we're from the same company, so this is more a bit of a fireside chat, but I think it reflects what goes on with senior management, and obviously liquidity is one of the major factors that we look at on a daily basis and sometimes on an intraday basis as well. So I think what we're trying to get across today is that these are the kind of debates and discussions that we have all the time in the market, because we're aiming to give our clients the best liquidity we can, while obviously looking after the company's risk management protocols as well. So I'll kick in and try and get you, Wei, you're looking quizzical at me already. I'm not going to throw any nasty ones in there. But I think one of the main things we're looking at is, like, now market asset, it's no longer a one-size-fits-all. We have different clients looking for different things, different ultimate clients as well as our institutional clients straight away. We've got those end users looking for different liquidity requirements. So how are we seeing the convergence of retail and institutional demand? And is it changing now? Are we seeing like a real emergence and convergence of demand? Or what are we looking for? What are clients really looking for the liquidity offering?
Shall I go first? Yeah. I mean, because I'm looking after Insta side, so I can only say from our Connect, it's our brand side. I haven't seen the convergence between retail and Insta. I have seen many retail clients become more professional in this market, and then they're asking probably more conditions normally retail clients wouldn't ask. So that's kind of close to Insta side. But when we talk about Insta, my understanding from my, I'm very old now, 20 years experience, is different from our common understanding of Insta, because people talk about the real execution, real market access, not like, oh, you're a broker, you're bigger, you become market maker, and then you just go against me. So really, how can I pass my trade, my transaction into the market, which is shared by more than one broker, and that they can give me a fair execution, not like during the volatility of the market, and then somehow my trade has been slipped so heavily because I'm making money, and then they are losing money. So from that angle, I think there isn't too much change, still same, but the difficulty will appear when market become so sharp. Yeah.
Siju.
Sure. I think Wei looks after Connect, which is our institutional business. I primarily focus on the retail business, and it's interesting because Wei and I still can't agree on what a proper definition of retail and institutional is, because when we get business, does that go to Wei's team or does it come over to mine? So I think that's something that we grapple with, right? And so how do you classify institutional? How do you classify retail? Because sometimes retail behaves like institutional. And traditionally, I've always thought of it as our margin clients versus our credit clients versus PB clients. And I might take a different view to Wei on this in terms of the convergence. I'll give you an example. Years ago, and we're going back about a decade, I remember one of our bank liquidity providers, market makers, came to me and said, listen, I want to know more about this flow that I'm seeing from you guys. I think there's an HFT hiding behind you guys. And we said, okay, like, pretty sure it's not. But they're like, no, we suspect it's, some sort of prop shop, more high frequency. And you guys, it's hurting our relationship. So I said, fine, can you send over what you're seeing? And they showed us the tickets coming through, and they were just getting slammed with a funky cross in very small tickets. And we looked at it. I took it to my head trader at the time, and he's like, you know what that is? It's an EA. And coming back to them and saying, guys, that's not, some HFT shop. That's not a prop shop. That's not some massive institution that's out to get you guys. It's an EA. And of course they're like, what's an EA? And ironically enough, they had never heard of MT4. They had never heard of expert advisors. The problem that this particular bank had was once we told him about this, his IT would not let him download any of this either, because obviously banks are notoriously difficult with their cybersecurity. So the head trader brought his own laptop. And some of you guys that have been in the business for a while remember this EA called Fab Turbo, right? And that's what he did. So you have one of the heads of one of the big banks downloads MT4, buys Fab Turbo, and he's like, okay, at least this way I can mimic or I can see what's happening. So my point is simply that convergence, I think, happens in a lot of ways because, again, how do you define Insta? How do you define retail? We have a lot of our clients that I maybe define as quasi-institutional. And so in terms of their level of sophistication, on my panel yesterday, I talked about it where, they are asking a lot more sophisticated questions about not only price or spread, because that's what you see typically from, let's say, a novice, but more so the quality of my execution. What does the top-up book look like? Is that a full amount? So on and so forth. So I feel like that convergence is happening a lot more.
Yeah, that's interesting. I actually had a conversation with a bank last night, and once again, still don't really understand what an EA is. And I come from the banking side of things from years and years ago. I didn't know what an EA was. In the banking industry, it's they call it a bot. It's quant guys, but it's fascinating, isn't it, that you still see, and we're still seeing that at the moment. But maybe from Siju's point of view, we are seeing that convergence coming in from institutional and retail. So just one of the things I think we're looking at is what do you think is driving this evolution if we are seeing a convergence of institutional and retail? Is it technology? Is it client demand? Is it regulatory pressures that we're seeing that now brokers have to give, and I hate to use the words race to zero, but brokers have to give those same conditions. And I speak to institutional guys, like guys that are sitting on bank trading desks. Some would argue that retail traders get better pricing than they can still see in institutionals, and so it's an interesting thing. So what do you think is driving this probably the race to zero, but the better quality of liquidity that we're seeing, and from an ATFX point of view as well, because we're seeing a lot of flow coming through, right?
I think there's two things. One is demand. I take the point of Siju retail side. There's many people asking for better conditions. They understand sometimes they probably wasn't treated fairly when they've been treated as retail clients. So want some real market access. So they demand high. They understand more. They ask more. I think another thing is regulatory, from my point of view, because I'm coming from more regulatory background. So when everything, the government or regulator want to make some change, they drive the evolution faster than the natural change of the market. Yeah.
Yeah, I mean, to your point, right? I think in some ways, of course, when it comes to information, access to order flow, the institutional desks are obviously going to dominate that, right? For sure. Now, at the same time, the retail trader today, because of technology, is armed with features, functionalities on his smartphone that the banks are still lagging behind on. Right? So if you look at some of the platforms out there, some of the charting packages out there, they're super rich, laden with features. You can program an algo very simplistically today versus, the bank side having to go and getting their, the computational finance guys and so on and so forth. Not to mention, you can have, particularly in a regulated jurisdiction like the UK, protections for retail that are not afforded to professionals. So you may have someone who's on the cusp who says, hey, I want the leverage, I want the no debit protection.
But I want to be retail.
But I want to be retail, right? And so they get to straddle both worlds, right? In some way, of course, like I said, they don't have the edge when it comes to order flow. They don't have the edge when it comes to information. They don't have the edge when it comes to balance sheet, but they are enriched with so many tools. And you could see just if you go and talk to a lot of the providers out here today, or why platforms like, for example, TradingView have grown in nature. So I would argue that it is technology that drives it. I think education, you'll see there's a lot more knowledge out there in terms of what's happening, and those two components, I would say, just the thirst for education, the knowledge, as well as technology. Again, putting everything in the palm of their hands in terms of their smartphones. I think that's just helped bridge that gap to a great extent.
Yeah, I think fantastic point. The amount of access that retail traders have now to liquidity and technology is huge. Obviously, I've already mentioned it, and I'm probably commenting too much rather than asking questions. But spreads are tightening, right? Spreads are tightening, and I think certainly we're very aware. Top of book is massive. How are expectations for liquidity, for pricing, how are they increasing, and how are liquidity providers in general dealing with these increased expectations, and in general, and obviously from an ATFX point of view as well?
Probably question from my side. We are facing a lot of competition because competitors they are reducing spread, they reducing commission, force other people to change as well. Otherwise, because from our side, in-state clients, they're shopping around. Okay, they don't sometimes they don't care too much about execution from beginning. So, okay, I got say $2 cheaper than you. Why?
Is that something you're seeing, Wei, where we went top of book, right? And everyone's like, what's your spread?
Yeah.
It's kind of irrelevant if you're dealing in size, right? Because your top of book can be the tightest spread in the market.
Yeah.
But if you're trying to execute and do a decent amount of size,
the result is different.
As a result, it's massively different.
Yeah. Exactly,
So
exactly.
are you seeing a lot of that?
Yeah.
And now, from a retail perspective, and then Siju, I'll probably come for you from the institutional side. Sorry, the other way round, right? Institutional guys, they'll be looking at your depth of book rather than just that initial, I suppose, marketing top spread. Mm-hmm. Mm-hmm. So from a retail perspective, is it still all about that tight spread, or is it now about depth of book?
So it's interesting to say that because, retail clients want zero spreads, zero swaps.
Yep.
Bonus promotions on top, and I have a friend in the business who says, I'll agree to all of that as long as you agree to zero withdrawals. Right? And
Yep.
so I think if you are new to the market and you don't understand and you haven't been through it, yes, of course, visually, that's all you can see. Right now, there's a few platforms out there where you can see top of book and you can see the price ladders and so on. But on the non-FIS end, absolutely not. Sometimes I say on the retail side of the business, I prefer to be your second or third broker. I almost want you to experience, what happens. Because again, it's not tangible, it's not visible. How do I explain that to someone who's never done it before, right? So having, I used to tell my sales team in particular, when someone does this, wait for after NFP happens. And then follow up and see how everything went. So as they go through that level of sophistication, it's like when I tell them, listen, I don't know, I'm from the United States, we have Black Friday sales, right? Here's a 90-inch TV for $2. Well, there's one available. So it's a similar concept, right? So on the novice end, absolutely not. What you have to do is have them go through that experience of slippage or non-execution and then kind of work your way through. I'll pass it over to Wei, but on the quasi-institutional side because they know that better, for sure. I'll pass that to Wei for comment.
We see many valuable clients from our point of view come to us with the experience probably being heard by other broker. They don't look at what's your top of book or something. As long as not so obviously wrong, they will check. Okay, let's have a test account. Let's trade. I post some money and I trade with you for several weeks, and then say how do you execute my trade, and then then go for next big game.
Yeah, so you're seeing institutional guys that they will put a lot of test trades through, whereas maybe on the retail side of things, it's just like, I want to see that. I want to see that tight spread. I want to see
it's
zero
just you have
commissions.
to experience it, right?
Yeah.
You have to experience it. Otherwise, it's hard to explain.
Yeah, it's an interesting point, I think. Moving on to digital assets, we can't avoid them, right? A lot of brokers are seeing a much more increased flow. Arguably, our industry missed the boat for the start of the crypto revolution, but now we're seeing a lot more flow coming through crypto. Are you guys starting to see a lot more crypto flow coming through digital assets? Do you see that expanding? We're going to start to see a lot more maybe digital crosses. Are we going to see sort of Bitcoin gold maybe, which has been a trade that's taught for a while?
Yeah, obviously. I think on my panel yesterday, I always say, whatever is on the headline of FT.com, CNN.com, whatever, that's what clients are talking about and asking about. And I think the convergence between digital and the CFD side rather, has been happening. Obviously, we offer it as a CFD, which is slightly different. And I think a lot of CFD providers, because we offer it as a CFD, we're still struggling with capturing crypto native flow, right? But you're seeing, obviously, those two worlds colliding. You're seeing the crypto space dipping into our space. You're seeing our space dipping into theirs. I think it's a non-starter that you have to have it. You have to think about it. We offer it from a deposit and withdrawal perspective in terms of digital. But certainly, we have plans and ambitions because we're seeing the demand for it. But, it's just based on demand what we're seeing.
And would you see CFD brokers as being a viable option for people hedging their exposure in digital? Because there's a lot of people that've got a lot of digital, they've got a lot of crypto. Being able to hedge their position with a CFD while they're holding the underlying asset, do you think that's something that's moving forward and we're seeing flows like that?
Depends. I mean, I'd have to look at the exact cost associated with it, because obviously perpetuals look very much like a CFD, right? But once I learned about how financing works on that side of the world, it's interesting. So you do have some, but I don't think adoption has been mass at this point in time.
But maybe potential there.
I want to, because there's some interesting point I mentioned before in previous event. I think we talk about our CFD market has been attacked from crypto market, vice versa. We also try to tap into crypto market as well. There's some issues I think probably right, probably wrong, but just want to share some views. So in our industry, financial industry, we are heavily regulated. We treat clients' money very seriously. Right? We have client money regulation. We have all the daily reconciliation. Make sure we have enough money to cover our responsibilities. And also, when clients trade with us, they have to convert the money into fiat. Right? Normally we don't use Bitcoin or crypto as a collateral, but in crypto market it's a different way around. If I was a crypto trader, I don't want to convert my Bitcoin to USD because I'm kind of religious to Bitcoin. But for crypto market, if they want to start a financial market, they have to have a license. That's why many crypto exchanges want to have a license now. They realize that. But when they have a broker license, I'm probably a question: can they make those two things in one? For now, we haven't seen that yet, right? So probably we still have to run separately for this.
Oh, excellent. Moving on to our favourite products, I think at the moment, metals. Obviously, we've seen gold smash records recently, although it got a bit of a hit again last night, 25% since it broke higher on the 2nd of September. Is this what we're seeing from retail traders? Are we seeing a massive demand? I've got metals written down here, but let's be honest, it's mainly gold and silver at the moment. So
Absolutely. Like, whatever's in the news is what drives it. And speaking to a lot of my friends in this space, it's the same exact thing. So anything that moves, anything where a retail client feels they can make a profit, that's what they're going to be trading. So we're seeing obviously a lot of interest in gold. We're obviously trying to, use that, and we're using gold against, like as you mentioned earlier, like against Bitcoin or against other exposures, just to kind of diversify a little bit. But yeah, again, I think if you look at most brokers today and you looked at, their product list and the amount of volumes that they're seeing, gold is going to be at the top for probably everybody.
Yeah, I think so. Wei, on the institutional side of things as well, we're still seeing.
It's the same. Yeah, percentage was probably lower, but it's the same.
Yeah, it's the mover, right? I think it's been 56% in the last year. It's a crazy move, and some of us are trying to explain it, and we can't. Onto the technology side of things, like, do you see? And I think you've touched on it already, where we're looking at crypto exchanges. We're looking at as a CFD broker, will we be that one shop that warehouses? We're basically a warehouse for everyone. Will people be coming to us for literally everything they need to do with financial products, or do you think we're still going to see a divergence, like guys that want to trade stocks, they'll go to the stockbroker, they'll come for us for CFDs, and then they go to a crypto exchange, or will we see these mega shops coming in the future? And obviously, will ATFX be one of the mega shops if it comes through?
I think that's a great question. If you look at some of the brands that have been around for a while, I think they've gone through that pivot already of expanding from CFDs to stocks to cash equities to fixed income and so on and so forth. So becoming a financial supermarket, so to speak. And I think there are different reasons for that. eToro is now listed, and I think you could look at their financials, but the bulk of their money is still CFDs, right? So I think a lot of players coming from our space who are expanding into that use that more so as a lead generation tool, right? And you can see that, I think, also from XTB, for example, right? They use shares and things like that because the universe is much bigger, the ecosystem is much bigger, you can acquire leads at a much cheaper rate, plus 500. These guys were the originals at it, right? But then you eventually want them to convert into your core product because your margins are a lot better. And then I think you see, again, these are the brands that have been around for 15, 20 plus years. Some of them have opted even to go as far as getting banking license to take deposits and so on and so forth. And the others, I think, more so combining CFDs with crypto and trying to figure it out. Now, I have a view from an ATFX perspective of course, whatever we can do to keep our clients within our ecosystem is great, and I think that's the rationale, right? So if stocks are performing better, instead of having them taking their funds out and take it to the other account, keep it all within the same ecosystem. And that's, in theory, that's great. However, for me personally, and when I look at my own behavior, I don't do that.
Yeah.
When I keep my banking with my bank, I keep my shares with a broker that's good at that.
Yeah, I suppose that would be my question. Is, like, what percentage do you think, and I think you've touched on it already, is that we've got a lot of CFD brokers that are cash equities, that you've got options coming in. How much of a percent, is it a bit of smoke and mirrors? Is it just they're doing these things, but how much of a percentage of the client base do you think are actually switching to trade multiple assets? Or is it really just a little bit of smoke and mirrors, and they're just CFD clients?
I'm pretty sure it's single-digit percentages. I've looked at the financials on that. Yeah. So again, as a lead gen tool, it's fantastic, right? If it's there, the ease of use, great. But the actual amount, in terms of daily active users, I would imagine it's relatively low. Like, so for example, the United States, I trade shares through Charles Schwab, and I've had, and I actually didn't even open an account with them. I opened it with originally Thinkorswim, which was acquired by TD Ameritrade, which is Charles Schwab. Now, I keep my long-term investments there. They're a bank, and they're actually a pretty good bank, but I still bank with Citibank.
Yeah.
So I like them for my long-term holding, but for my active trading, I still prefer a different broker for that. So again, I think if you look at the listed ones, and again, IG and some of these guys, they're all listed. You can look at the financials. As a lead acquisition tool, absolutely. Even if you're only able to convert 2 of them, your cost of acquisition is much lower on some of those other traditional products.
Fair enough. Why?
I use analogy. If you you want to buy something from for you probably hurt yourself or something, it's very urgent. Probably go to a supermarket very close. But if it's not urgent, you prefer a pharmacy, right? Because it's similar thing. Our products are very professional. and you put your money with some institution, you want some safety, security, you will go for somebody more robust, so more secure. Not like, oh, there's a micro shop here, they have everything, I'll go in there. I think the idea of micro store is not my choice.
I think one company that I've seen do it quite well though is Robinhood, right? So, but again, when I think of the users of Robinhood, and I have an account with them as well, and my friends that use them, they don't generally do their long-term investments with Robinhood, right? So they started as this very memey, gamified approach, and they onboarded a ton of users. And then when crypto was ripping, they offered crypto, and you could see the numbers on crypto are fantastic. And they added prediction markets on top of that, and that's also going gangbusters for them. So I'd argue that those three products have a lot of commonality, right?
Yeah.
And that's why I feel like their numbers are quite strong. So when I look at the crypto and digital numbers that they're throwing out, the prediction markets that they're throwing out, there's a lot of crossover there.
Yeah, interesting.
Crossover between spec high leverage products and your traditional low leverage products, less so.
Yeah, interesting. Before we throw some questions out to the extensive crowd, I feel like this is like the end of an interview. I'm like, so in the next 5 years, I've got this written. Where do you see retail traders and our market? How do you see liquidity, analytics assets? How do you see it going in the next 5 years? Some people have said there's a case that we may see pricing actually move out a bit, where we get to real levels where people can actually trade in real amounts. Is that something you see moving forward, or are we just on this race to zero?
I think there's two components to that, right? So in retail, you're also seeing a land grab, so to speak, right? And if you look at most players out there, everyone went for their traditional markets, be it the UK, EU, or Asia Pacific. But then I think regulations forced brokers to look for new markets, greener markets. So you're seeing, Africa being explored, Latin America being explored, which we got into. You're seeing Central Asia being explored. So there's a bit of a dichotomy there where the well-established entrenched markets can do what you said, which is they'll realize that zero spreads doesn't exist. Choice spreads don't exist in the retail space, right? So it goes back to, can I give you a good price with good execution for some of those markets? But for the newly established ones, where brokers are just entering, I think you're going to see that they have to go through that learning curve, all over again. Again, the race to zero happens more so not necessarily clients.
Even if they've already learned, they have to do
they've
that.
already learned, but again, it's also competition, right? It's like, okay, I'll offer you whatever 1 pip, someone's 0.8, 0.9. It is a race to zero, as you said. So when you enter new markets where they value, okay, you understand that there's an additional component to it, you're going to see that obviously there's a bigger margin for it. But, to your point of, do you think they would go the other way? Well, I've seen that, certainly on the institutional space, I'm sure Wei can comment on it, but they understand that. They understand, okay, it's not a real price, it's smoke and mirrors. I would rather you give me, a price with a full amount. Or, for example, can you give me a fixed spread? I can, potentially, but, we have to discuss the top of book, we have to discuss what that spread looks like.
Yeah. Wei, it's probably, as I think Siju just pointed out, it's probably more apt for yourself because there's let's be honest, probably a greater understanding from the institutional side that there's a real market out there and there's a marketing market.
Because I think, my understanding for your question, correct me if I'm wrong, like the analysis of clients' demand of information, probably in the next 5 years, are you seeing retail clients more demanding for the professional analysis information? In my opinion, probably retail side, yes, because retail clients always want to have more information, always want to know more, how can they trade more profitably. But from institute side, we rarely see people coming to us, okay, I want your access for the market, for the pricing, but I also want your service. I also want to see because we recently published a magazine from a client side, want to see your magazine, want to see your opinion. Because they got more information from more professional channels, Bloomberg or Reuters or whatever. They don't think we are at that level to compete with them. And then they have their own way to solve the problem. So I think for retail side, definitely you'll see more demanding. We need to plugging some information to them, but instead said not too many.
Okay.
But in terms of the information, for example, we offer bank research to our retail clients, right?
Yeah.
But it's written by a bank analyst with no retail minded. So they'll ask for it, they'll get it because it makes them feel special. And then as do I, when we used to trade with all of our different liquidity, I would get all the research from all the banks, and at some point I had to send them all straight to my spam box because it was not written for a retail audience.
She's not making me feel great.
That's the reality. The reason is, I used to work with FXM, and we ran daily FX, and I used to tell our analysts, like, write to a 10-year-old audience, right? Because if the thing is, if you overcomplicate it. So I had a great analyst work with me, right? And he loved he was just Fibonacci was his thing. Yeah. And I had to tell him, his name's Jamie. Come on, like no one's understanding what the fifth wave pattern, like is that Ichimoku cloud or whatever. But whatever it is, you had to simplify it. So to Wei's point, from the retail side, what works, and there are great providers here today at the expo that do stuff like this. It's visual, it's graphical, it's simple.
You kind of talk about my daily. Luckily, I'm not clever enough as some of those other analysts, so I get to talk on a retail level. It's great. Just before we finish up, have we got any questions from anyone in the audience that want to ask about liquidity or anything to any of the guys? Anyone out there? Nothing? We've obviously clearly put you all to sleep.
I think so. Very engaging.
Yeah. If that's all good, then I think we'll end it up. But thank you very much,
guys.
Thank you,
Thank you, Nick.
Wei, Siju, thank you.